media. Yes, it's a little bit of a tough, rough and tumble morning, but yes, here we are. Just to get into things, I think on the spirit of catching up with things, let's get straight into how the markets are actually looking for today. It is Wealth Wednesday. Let's get into our market roundup. It's the second day, Vernon, of the Kwacha actually getting stronger. So this has actually been a shock to everyone. 4.02% strengthening in the Kwacha yesterday. At the end of the day, it actually closed below 19. So we've actually seen it. The dollar is down to only 5% up year to date. It's still in buying position, but you can see it's starting to slow down with its MACD directionality showing that it is only slightly in buying position. Simultaneously, we are seeing that the stock market yesterday did close only at 8,188, still stuck on the same place, while the bond market was up 0.6% and then dollars up 3.5%, up just slightly on the interest rates. We did see that obviously exchange rates also even against the rand came down. So you can see that month to date, 1 month rand movements are still only up 6.97% versus the dollar, which is only up 3.61% on the month. So we actually are seeing that strengthening of the dollar, of the kwacha picking up. Now, it does seem like it's tax season, so these could potentially be tax payments actually coming through for the end of the period. Especially the ones that are relating to the last quarter coming in simultaneously. So you can see that we'll be seeing some of these flows of cash coming in. Now, remember, we even have deals like we even have quarterly deals such as Kansanshi and ZCCM, where there's going to be minerals, a sort of mineral royalty even paid out there. So there is a little bit more dollar flow that's actually going to be helped into the system to help trying to ease off or net off some of these issues. But on one side of it, these are some of the concerns. But also simultaneously, we also are seeing the pullback of things like the cost of oil as well, which is also starting to come back again. It's rippling up and down. But cost of oil, cost of fertilizer, all sorts of things. We're out of the fertilizer purchasing season. So that pressure on fertilizer and agricultural inputs has also left out of the system as well. So pay attention to that as well. We also are seeing, as we said, bond yields are up 12.22%. The bond index is up 12.22% year to date, while we're seeing in dollars it's up 7.18% versus the GRZ composite bond index, which went down again, but less than a basis point yesterday. But we are seeing it still teetering around this 24.11%. We're not seeing any movements on interest rates yet. That hasn't pushed, there hasn't been any major buying on the secondary market. So it's no signals yet that it's our debt issue. This probably looks like tax payments coming in dollars that have been flushed into the system, and potentially a few slowdowns in purchasing, as I said, of agricultural inputs or imports. Now we also did see yesterday copper up 1.9%, mainly because China. News on the commodity market is mainly because the Chinese government, the Chinese central bank, dropped interest rates yesterday, the first rate cut in 10 months. So that was one of the big news that actually pushed, and that's why you're seeing oil up 2.95% and copper up 1.95%. Oil back at 74, copper up at 8,455 per ton, while gold is still down, is still holding the position, down 0.1% from yesterday. But when you're looking at wealth insurance assets, cryptocurrency down below 500,000 again, 3.5% down on Bitcoin, Ethereum down 4%, while gold is down 4.11%. All of these are mainly drifted down by the strengthening of the kwacha. So you can see remember, we measure our wealth insurance assets in kwacha. All of these things that you can get from even local wallets now, finally, they are actually means by which you can hold some of your wealth in here. Remember, I told you in total, your dollar, cryptocurrency, and gold wealth should not exceed 15% of your portfolio. We call that wealth insurance. Okay, that is the maximum it should be, and I keep telling you this on and on and on, and hopefully one day you will pay attention to it. The other part of the equation, Vernon, we are looking at things across the board. We have seen Bitcoin year-to-date returns 65%, Ethereum up 52% year-to-date. Now, remember, these things were up at 70s. So when you're looking at the 1-month returns, look at the Bitcoin down 2.3%, on the week down 7.6%, Ethereum down 11%, while on the month it's down 2.07%. So as I said, you can see the massive volatility in the stock market, up 11.6 year to date, bonds up 12.2%, gold up 13.7. So there's still this defensive posture to the market. No, we haven't yet seen the strengthening of the currency, whether this is going to hold. I'm not sure. The test, Vernon, is going to be whether if this is a proper Kwacha rally, then it's going to have to persist beyond the 14th. Anything that just happens just around the time of the 14th, those are tax payments. Anything that persists after the 14th, then that's an actual change in sentiment continuously. Now, the only thing is there's no sign of where this is coming from. Copper output has been down. Copper prices have been suppressed for the previous quarter. We haven't sorted out our debt. So the source of dollars, we're not sure. Unless you're telling me the World Bank saying they're going to give us $100 million, just voila, changed everything to try and help in sustainable tourism. Doubt that made an impact instantly. So you actually are seeing this is just, like I said, this is probably just tax payments being dealt with. Now, in terms of our four horsemen, this was the news that did come out yesterday. German and Spanish inflation dropped 6.2% and 3.2%. Inflation in the US drops to 4%. That was a big story from yesterday. While Namibian inflation rose from 6 to 6.3%. So a little bit of inflation in Africa, but held still. Ugandan kept their interest rates at 6%. Kept their interest rates flat at 10%. Italian bond auctions auctioned at lower rates, while the Chinese loan growth did come in slower. But this is going to be stimulated by the fact that the Chinese central bank did drop interest rates recently. But UK 10-year gilts also auctioned higher. So we're seeing that risk premiums are starting to come back in normally, but curves are starting to flatten. The UK earnings accelerated 7.2%, and unemployment dropped to 3.8%. To 3.8%, while employment grew by 250,000 in US. Small business sentiment also rose yesterday as well, while EU and German sentiment figures also came in negative. So you have mixed economic outlook globally, while you have interest rates starting to cool down a little bit and curves starting to flatten. Those curves starting to flatten and hopefully steepen. It means that there's a little bit of growth ideal coming back into the economy, and we're not sure whether this feel of a recession is going to be what's going to persist going forward. So, Vernon, let's get into our daily deep dives. So let's get into our daily deep dives and some of the news that we have actually been touching on today. Main stories that did come out yesterday, daily deep dive number one, happens to be that, main story that we did, I think these were some of the stories from yesterday, but we did see that Kenya is set to face higher sugar inflation set to face higher sugar inflation due to shortages and low production. So Kenya is set to suffer sugar supply crunch, leading to record levels of sugar selling, record levels of the sugar price selling at $1.56 per kg in Kenya. That's something that's actually been quite interesting happening there, and it is something that we should actually be paying attention to, because that actually affects some of our growth opportunities. Actually, in some of our growth opportunities in our sugar industry, for example. Now, low production from South America and export restrictions in India. India has actually been restricting the export of sugar, has actually led to a lot of the economy. So a lot of India holding back its exports. Now, because India has chosen to hold back some of its exports, as a result, there's been low supply on the market. So altogether, we actually are seeing sugar actually going through a supply crunch. That might be good for Zambia, because remember, we do have our third biggest company on the stock market is actually a sugar company and a sugar exporter. But we are actually seeing, however, Brazilian supply is set to rise by 23% in the second half of the year because of better rainfall and possibly better policies. Now, here's just an example of what we mean by sugar prices altogether. I think Kenya, we have seen it, at $1.51. We did see that the global sugar price is at 56 cents per kg, while Zambia's sugar price is at $1.15 per kg, and the Kenyan sugar price is currently sitting at $1.51 per kg. This is why I'm saying trading with our partners in East Africa might actually be the best selling point. So what's happening in Kenya can actually create export opportunities for Zambia. But if we start selling at that Kenyan price, it means that the local producers are then pushed to either increase production, which may not be possible because this is an agriculture-based stock, or actually try and get as much output out into these countries, leaving a shortage in Zambia and potentially pushing the Zambian price up. So you see how economic growth always costs inflation. Okay, because if Zambia's sugar producers want to start attacking the Kenya market, it means increasing the Zambian sugar price by about 30% or having a stronger Zambian FX rate. But for us to be able to now get into the Kenyan sugar market, or for us to now try and push as much profitability, it requires this. So I think it's food for thought for people to understand how inflation is actually working. Now, obviously, on the global market, it's a bit cheaper because there are obviously countries that still have lower costs of production. But this is something to actually start thinking about. And now, this is the historic sugar price globally, is to show you what they mean when they say sugar prices are currently sitting at an 11-year high. This goes back as far as January 2013. We've seen that sugar was at 42 cents, 42 US cents. While at the same time, you're also seeing that it peaked at about 49 cents back in 2016. But you've seen that when we look at the beginning of the pandemic, sugar prices were only at about 23 cents. They have rocketed up to about 56 cents. So this shows you why sugar prices are the number one thing that are actually causing heavy inflation, mainly because of India, and also mainly because of Indian production, and mainly also because of South American production levels that are low, causing exports to be low on the market. This is a benefit to companies like Zambia Sugar, and this also helps them because their export income will probably come in stronger. And a weaker currency here, plus stronger prices in dollars, plus stronger export income, will probably mean a lot of top line growth for them in the second half of the year, meaning that they've got more room to run. And as a stock, that's probably good for them. We also did see that crude oil surges higher on three pieces of news yesterday. We did see that crude oil prices also went higher yesterday with the help by the U.S., by the U.S. CPI print, Chinese rate cuts, and an OPEC report. Now, the U.S. consumer prices yesterday recorded the smallest annual increase in inflation in over 2 years, supporting the view that the Federal Reserve, which is set to make its decision this week, are probably going to pause rate hikes, or at least there's a pause coming very soon. So that is triggering people to now start saying they can go back onto the market using low capital, and probably will find that they can now start buying up those commodities again. We also saw that the Chinese central bank lowered its short-term lending rates for the first time in 10 months, meaning China has also opened up a lot more capital. They opened the spigots for a lot more capital. And also OPEC has said in a report that world consumption will exceed supplies by roughly 2.7 million barrels by next month. So these are three signs: more cash chasing things like oil, more cash for economic activity, more cash chasing things in oil demand, while also OPEC, looking out and seeing a higher demand. These three things signal to the market that oil prices are supposed to go up, and therefore we're probably going to see a little bit more strain coming in. So this is between whether our exchange rate will be strong enough to counteract what's happening in the oil markets or not. I think that's another question for us all together. Now, finally, just looking into the other part of our show, Vernon, it's our chart for the day. Now, our chart for the day, the reason I'm looking at this is because Federal Reserve rate decisions are going to signal whether we're going to get back to easy money or we're going to keep seeing tight money. And this is kind of the signal that's actually showing that sticky inflation remains a danger given Fed's determination for core inflation. Now, one of the problems that's happening in America is yesterday we did get headline inflation came down to about 4%, so it dropped, but core inflation is still staying around 5.4%. In other words, if you remove agricultural commodities and you remove oil and energy, oil and gas, and you start to look at the cost of things, that's the signal of the supply chain. Core inflation is when you remove transport and you remove food. Those are the two main things. When you remove oil and you remove food, what is remaining? And when you look at the rest, those are supply chain based price hikes. And you're seeing that those ones are still stuck. That blue line. Now, if you take a look, that blue line is almost flat. And that's what they mean when they say sticky inflation remains a danger, given the Federal Reserve wants to bring it back to the target rate of 2%. So you can see that the Federal Reserve has literally been firefighting, trying to push these interest rates up, especially throughout 2023. They've literally, this is the expected H2 2023 interest rates. So people are expecting that the Federal Reserve are still going to push out interest rates higher because of the core inflation that is not coming down. So that is the battle that they're having right now, whether to push out more money. Now, how does this affect Zambia? Well, this affects Zambia in one specific way. When you sort out your debt, okay, the interest rates in America become the benchmark by which offshore investors are going to expect to invest in Zambia. So there are two things that are guiding the offshore investor when they want an interest rate in Zambia. One is the London interbank rate, which is closely linked to things like the Federal Reserve. The London interbank rate is currently sitting at about 5%. Okay. And then there's Zambia's default premium, which is just over 21%. So you see that the offshore investor is looking for a return on investment in dollars of about 27% when they come into Zambia. That's pretty much, sorry, I mean in local currency, they're looking at about 27%. Now, if they're not getting that 27%, then they're not comfortable investing in Zambia. That's the issue. So as long as this baseline interest rate keeps going up, then that means the demand that they want from Zambia also keeps going up. So the Federal Reserve is indirectly affecting us. Remember that when the whole IMF talks and the creditor negotiation started, you were dealing with a world where interest rates were low. President Chilema walking into power was walking into single-digit rates. Those are the things not single digit. He was walking sub below 1% rates. Interest rates in the American bond market were really low. Now he's negotiating with rates above 4%. These are rates unseen in a long time. So already this whole battle of how the Federal Reserve is going to play this out is really going to be a serious thorn in the side of how we're going to deal with our debt. Now remember, our interest rates on our debt are going to our ability to pull in offshore investors is going to affect whether or not we're going to be able to generate an income. So you're going to be able to generate enough inflow to bring down the FX rate, because we are depending now in this situation on trying to bring in bond flows to try and cool down our FX rate and then grow our economy. So because if the offshore investors come in, they push interest rates down, they push the FX rate down, which means that a lot more capital squirts out into the equities component of the economy, and the job market and the equities market grow faster. Those are the two main things that they're trying to target. The credit markets have done very well, yes, but they're looking for the job market and the equities market to grow faster. That's why policy is trying to push. And that requires the activity of offshore investors to be able to do that. But for now, you're seeing that resistance because of that. However, remember yesterday I gave you a story that JP Morgan and Morgan Stanley have actually pushed to say that they are now looking at emerging market investments much more for rate cuts. And also because China had signaled that rate cut, that's also a signal to them to start buying up a lot more secondary market instruments in these emerging market economies, especially 10-year bonds, all these long-term ones. They're looking to capture as many of those as possible in countries that are not in a horrible default situation. That, Vernon, is our basic view of where we are. But if you take a look also at the Federal Reserve, inflation remains well above the Federal Reserve target. So this is where the problem is. Personal consumption, ex-food and energy, you can see it's still sitting around 5%. Now, some other news that we've also picked up here is also Saudi Arabia's profitability of oil prices. This is a chart that comes from S&P. Saudi chemical companies maintain above average profitable even in downturns. So you can actually see that Saudi Arabia is benefiting a lot from a lot of these price movements upwards. And that brings us, by the way, and I think one of the stories I should actually point out is that in that story, it also said Saudi Arabia is looking for the oil price to stay at 85 or above, because that is huge profits for them. That's their target oil price. And that's where the benefit starts to come from them. Let's quickly just grab a question which is coming here from Wale Mkangwa, who's asking here, saying, morning, Munyumba. If offshore investors don't get 27% on bonds, does it mean they won't flock into our market? What will attract them into our market? Cool. Right now, the two things that they're looking for when they come to a country is, one, are they getting more than what they're getting in their country? One. Two, are they getting more than what the risk is of investing in that country? So that's why I said when you add up the LIBOR rate, which is what they get just trading with one another in their own countries, in the safe jurisdiction of their own, what they view as low risk, then also the risk premium, the credit default premium that we have on our debt of about 21% due to sorry, 20.7%, but getting to 21% due to our default status, getting us to 26 to 27%. That is what is signaling to them. That's why it's not looking attractive to them. The risk is looking too much for them to be able to come into Zambia. Now, what will make them flock into our markets is one, debt resolutions. There is an appetite already for the major banks to go into EM credit. They already want this. So you can see that auctions that are happening in Mexico, auctions that are happening in Indonesia, they're getting huge amounts of offshore participation. So you actually are seeing American capital going back out into the world, because I think they've kind of realized that the interest rates they're getting in America, that's where they're going to go. So if they want anything higher, they need to go and play the EM game. So that's what they're pushing for, especially because emerging markets economies were raising interest rates for a long time. Their interest rates are already elevated. So now they're going to go into those markets and start piling in and buying as much as they can. The thing that's prohibiting them from coming into Zambia is one major thing. The biggest thing, about 80% of the interest rate they're demanding is literally the debt default situation. Once we get our debt reprofiled, it brings down their rate. Okay, it brings down the rate that they're looking for. And therefore, now these institutional investors can come into Zambia a bit safer because, one, they'll look on the secondary market and find 160 billion kwacha worth of secondary market bonds, all trading with yields above 20%. That's the first thing they're going to spot. So they're going to go surging into those markets to buy up as much of the bonds on the balance sheet of banks. That's the first step you're going to find them going through. They're going to buy as many of the bank's balance sheets of secondary market bonds, and they're going to start pushing the prices down. As a result, the banks are going to make a huge profit, and cash is going to be available from the banks. And as a result, banks are going to be flowing with cash. But then because of that, they've also signaled that in the next auctions, they're going to want lower rates. So therefore, that will push the government interest rates down. Once that pushes the government interest rates down, lending rates come tumbling down with it. Okay, government bank lending rates start coming down with it, and therefore a lot more people start taking more risk to make more money. And the two main ways you'll start to see is banks will lend more. People will go to a bit more higher risk, whether they can access high yield and corporate bonds. Those ones will probably have a little bit more of a higher interest rate. They'll also start pushing. People start pushing into risks such as the stock market, looking for growth opportunities or looking for dividend stocks on the stock market. So you will see a lot more capital going into riskier areas. What will pull them in is once you wipe out that debt. This is why there is so much emphasis being put on the eradication of the debt situation in this country, the resolutions to the debt. This is why there's so much emphasis on it. So much of our financial system hinges on this debt being resolved. And the only problem we've been having is America and China have been at each other's throats, and it's been very difficult for these two to meet and get to a resolution. Because there's always this one didn't pass the papers, this one didn't do this. So that's been the main issue. But once they do that, then when there's a resolution hit, then you can start speaking to the private creditors. Once the private creditors have an agreement, once you've got a private creditors agreement and a institutional creditors agreement, that is when now you get a reprofiling of your debt. Once you get a reprofiling of your debt, the bank capital starts coming into your bond markets. That is the sequence of events that has to take place. And I think there's a follow-up question. Once again, that's not a problem. To what level will debt restructuring lower our risk premium? And could this take us until the end of the year? We're not sure about the timelines when it comes to debt restructuring. To be honest, it's not in our hands as a country. To what levels can it actually fix it? Well, you can actually half your risk premium from about 20. Some of the countries that are operating with a much lower risk premium than Zambia, they're operating somewhere about 10% above. So that can actually start to nudge down the rates demanded by about 10%. And going forward, if your ratings start to improve due to growth prospects, that's a different story. But right now, we looking at the other comparable ones on the NYU table of credit risk scores for most countries. Somewhere around 10-13% is the risk premium for something that's out of default. So if we actually get reprofiled out of default back into a growth status, then we're looking at about the risk premium sitting from about 20.7 comes down to somewhere between 10 to 13%. that will actually now reprofile people to now start saying we're looking for 18% return on investment in Zambia. The rates they've got for us, that's wonderful. They pile in, buy up what's there right now, push everything out, squirt a lot more capital into the system. So that's the effect it can have right now, because right now the rates are too low for the offshore investor. They're not attractive for them. So that's now, could it take till the end of the year? You know what? I'll tell you one thing. You need to prep yourself for this to be a hard, long slog. I think if you go back to even President Mwanawasa came in looking for trying to get a resolution to our debt. It took him 5 years to do it. Now, yes, we have ambitions to try and do this early, but you have to prep yourself. Sometimes these things take almost about 5 years because you're dealing with trying to coordinate multiple countries, and there's the added layer of complexity of dealing with the offshore investors, the euro bond holders. Hopefully that answers the question. That's a good question for as many of you, especially of those of you who are getting ready for the bond auction happening next week. There's even a T-bill auction now. Interest rates are still creeping up in treasury bills and bonds, so that already tells you that we're not out of the higher rate environment yet. So until we start to get that picking up, our sentiment is not as strong. Simultaneously, by the way, if you do get that flood of capital that comes in, just to give you an example, in quarter 3 2021, when President Chilema won, on hopes that we'd be able to get a debt resolution within the first 6 months or towards the first year, $200 million of capital came into our bond markets just in those 3 months. Okay, that's what started setting the exchange rate running down, and even the interest rate started coming down to about 14. The yields, if you could see, the yields were now heading towards about 15, and that's where we started to get that push down on interest rates. And then we even had that stock market rally that pushed into record levels, and we're now at record levels of the stock market right now. So that already sends a signal of how much capital these people have ready to aim at a country like Zambia. Okay, $200 million can literally turn your a quarter can turn your economy upside down. That says a lot. So, and you're dealing with banks that are worth trillions, that have got 4 or 5 trillion on their balance sheet. The American banking system has got trillions on its balance sheet, meaning that hundreds of millions for Zambia is a drop in the ocean of how much firepower they have ready to start going back into the global economy. Right. So that touches on to that. And let's get into our topic of the day, Vernon, which is we're talking about, this week we've been talking about the good steward. We started off with the mindset of the good steward of money. We then switched into the financials of the good steward, the diligent earner and the prudent spender. The prudent spender. Today we're going to be talking about the cautious creditor and the cautious debtor and the wise saver / investor. Those are the components of the good steward of money. And then we'll be talking at the end of the week about the generous giver, how that kind of ties up together. But I wanted to share a video very quickly from Dave Ramsey, where he talks about money mentality. Okay. And I want us to just quickly pay attention to what he said here. So listen to this.
That keep you in the gutter. Yes. But actual economic activity is around here for you to participate in and has cause and effect and get out of there. What you plant is what grows. If you plant nothing, the government's not going to come along and plant something. When it rains, you're going to have mud. And you can eat mud pies and make a mud hut. But if you plant corn, you'll have corn. Voila, when it rains. And don't be shocked that corn grows if you plant corn. If you do rich people habits with money and have rich people mindsets with money, eventually you will be rich people. If you do poor people stuff with money and you're rich, eventually you will be poor people. Have you ever seen a trust fund baby do stupid stuff? Have you ever seen somebody win the lottery and lose everything? They do poor people stuff with their money, short-term thinking, and they get stupid and they lose their money. I've done both. I know how it feels.
Okay, so that's something, sorry about that. Let's just get that out. So that's a state of mind that he's saying. I don't know if you got any thoughts on those statements there, Vernon. I know those are sharp tongue statements, but I don't know if you have any thoughts there.
I think it is factual. It's just being rational as well. This is what I always share with people. I tell them, as much as the excuse of misuse or mismanagement of money is well, I just need a better job. I just need more money. And I always tell them, even as much as you can get the most paying job, at the end of the day, you're having the most money. These guys who do lottery are just by a perfect example. As much as you can give them a lot of money, at the end of the day, they will not do nothing with it. It's just that simple. It's how you yourself you handle money, not the more money you have, the more wealthier or the more wiser you become with money. It's just as plain as that.
The Bible says it very clearly, Vernon. He who is faithful with little will be faithful with plenty. If you cannot be faithful with little, you won't be faithful with plenty. If you're not a saver as the income you have, I know people say, no, but once I get more, the once you get more, you will spend more. There are all these things you've been salivating over, desiring. Let me tell you the truth, Vernon. It already, at the state you are, okay? If you're failing to put any money away by any means necessary, what it's saying to you very carefully, and you have to think about this, what it's saying to you at the state you are in is that you are already living beyond your means. Already you have a proclivity to live beyond your budget because you're supposed to be living in 75% of your inflows. And we all know people can say, no, but I don't earn so much. Good and well, Vernon, that there are many people who earn much less than you. And they have to stomach harsher conditions, but that's the reality. Whatever you're earning is reflective of what you have, as in whatever you're living has to reflect what you're earning. So just for everybody to understand that. So already, if you're living to the ends of your earnings, that means you're already stretching yourself way beyond what you can afford. Okay, so you know the statements, Vernon. Want what you want, but buy what you can afford. So let's talk about the cautious, the wise saver. So remember this. I had this planed out for you, and I'm keeping it here because these are 5 pillars of who you should be with money, and this is stewardship according to your faith principles, and it affects how you think of it. So the question now is: so the first mindset I'll tell you of the wise saver, which is the third pillar here, is they save because it's wisdom. It's not fear. They're not scared, and that's why they're saving. They're saving because it's wise to do so. Now, there's a difference. I'll tell you why. The person who saves out of fear will only start saving for retirement when they hit 45. That's when they'll see, ooh, retirement is 10 years away. I'm not going to end up destitute. Let me start putting away what I can now. Okay, seeing if I can get ready for it now. The person who does it because it's wise starts in their late 20s and early 30s latest. Okay, they start to figure this out and say, I'm going to give myself 20 years to plant the right investments correctly. And as a result, most of those people, I've noticed people who start the journey in their late 20s, early 30s, by the time they hit their mid 40s, they actually had a very substantially strong rate because they already started building very strong habits going all the way through. So the wise saver is one that's not fear-based. They don't start putting things away because they're scared something's going to happen. They start putting stuff away because they realize certain eventualities and they're able to start allocating very well out of wisdom. They do it in a calm way. The reason why that's also important, Vernon, is that they don't invest with fear. They invest with wisdom. People who invest with wisdom look for trends. They look for the ways the cycles of the markets move, and they see in the long term. People who invest with fear see a sudden movement. They see the kwacha get stronger. They suddenly rush to try and buy dollars, trying to get richer, and then they start losing. They look at sudden price movements and they react suddenly. While people who invest with wisdom, they take long-term outlooks. They look for trends. They look for principles, and they look at how things roll in general. The wise saver is also not a hoarder of cash. People sit on huge cash positions, Vernon. Huge cash positions. Okay. They sit on, and here's the two things I've noticed with people where I've seen balance sheets going wrong. There's a lot of stuff that they're hoarding that's not making any money, that has no economic activity on it. They're holding piles of land, Vernon, piles of it. Okay, bare land with nothing on it, no economic activity happening on it. Land they are holding, praying that the price goes up and praying somebody will buy it from them at a higher price and hoping that they don't have to liquidate it at a time when they're in economic distress. Those are a lot of ifs waiting to happen. Okay, And they're also sitting on piles of cash as inflation sits at 10%. So they're getting it eaten by the moths of inflation. So the wise saver needs to avoid hoarding things, storing money in things that don't make money, putting your money in the beautiful house you live in more than you're putting it in the houses that you have put on rent. Okay, putting your money in stuff rather than bonds. So there's if a lot more of your wealth is sitting in things that don't generate cash versus things that do generate cash, you are hoarding. Okay, so even if I don't care how much land you have, how much stuff you have, if most of your balance sheet is in things that do not generate cash, you are a hoarder. Okay, so do not be a hoarder of wealth. The third thing I'll tell you is that the wise saver saves and invests as a result of their budgeting, not by fluke, not because they earn a lot, not because of this, but because they earn, they budget, and they've got money that they can allocate towards savings. They've worked that part out. The wise saver is also risk conscious. Okay, they understand that there are risks in things, so they balance out their risks. They understand how to manage risk. The wise saver does not engage in get-rich-quick schemes. They don't try and think they're going to become the newest millionaire by farming online. Okay, that is not how they do things. They invest in things that are tried and tested, that have been around for a long time. They put their money either in unit trusts that have been around for a long time, buy stocks and bonds, put out rental property. Remember what I said, Vernon? The majority of people with 2 million kwacha wealth or more in Zambia have got it in bonds, buildings, and benefits. These are the three areas that hold a lot of people's wealth. Okay, the people that have managed to put together substantial amounts of wealth, it's bonds, buildings that go on rent, by the way, and benefits. This is where their wealth is sitting. The other thing is they also seek wise counsel. Okay, they value wisdom. They value speaking to people, Vernon, who have wisdom, who are also people who are also intuitive. They speak to professionals. The wealthier people get, Vernon, the more professionals they try to surround themselves with, and also they make sure they put their money in things that make money before they put their things in money that they like. They put their money in things that they like. So they make sure they think pragmatically. How about I build rental flats first before I build dream one? How about I put my money in bonds and all these things first before I buy that car, which is going to reduce the value? How about I start putting my things in things that make money before I start hoarding a lot of land around? So they make the decision to put money in things that make money first before they start trying to build up their housing. And also, Vernon, they diversify. The book of Ecclesiastes also talks about this. They tend to diversify. They don't know where the storm is going to hit. Ray Dalio says you don't know which of these assets is going to lose value. So diversify decently. So that diversification through various assets, through bonds, through stocks, through various things. I tell people start with bonds and then diversify later, but that's just a point I wanted to put out there before we kind of wind up today. I know we didn't have enough time for the cautious debtor. I'll be going into that on the other side of things, the cautious debtor and the diligent earner perspective of entrepreneurship. I'm going to talk about the diligent earner and the prudent spender into the perspective of an entrepreneur, and also the cautious creditor tomorrow. And then we're going to go into the generous giver at the end of the week, so that we have the steward's mindset going into this. But yes, Vernon, final thought, as was said, if you do poverty things with money, you will be poor people. If you do rich people things with money, you tend to build wealth. That's the simple thing.
Thank you so much. You have a good one.
Cheers, my man.